You tap your card at a terminal. There is a brief 1.5-second pause, and then the screen flashes an approved message. While it feels as though a digital equivalent of a physical coin has just traveled from your pocket into the merchant's register, no physical asset actually moved during that second and a half. Over 90% of the money in the modern economy exists exclusively as records in centralized digital ledgers. Your bank balance is a database entry, not a vault of cash. Moving money is the execution of highly secure, authenticated data messages across decentralized interbank networks. These messages act as instructions for a distant server to update its ledger. Because money is defined by these database entries, the stability of the financial system depends on the ability to prevent unauthorized edits to those ledgers. To understand how these entries are protected, we have to dilate that 1.5-second transaction window and deconstruct the cryptographic architecture and algorithmic logic gates that secure the data in real time. This process begins at the point of sale, where your account details are first converted into a secured payload. The journey initiates the moment your physical card comes within centimeters of the terminal. They communicate via near-field communication, exchanging short-range radio waves. Transmitting a raw 16-digit account number over an open radio frequency presents a clear vulnerability, as the data could be captured and reused by any device listening to the network. To prevent this, the system uses pan tokenization. The terminal replaces your actual account details with a randomized one-time use digital token. If a bad actor intercepts this payload, they acquire a string of characters tied to this specific purchase that cannot be used again. Physical cards add a second layer of defense called an EMV cryptogram. The embedded microchip generates a unique cryptographic signature and attaches it to the token payload. The microprocessor computes a distinct pattern for every transaction. If a fraudster attempts to replay a previous transaction, the receiving bank automatically rejects the duplicate cryptogram. This secured token and dynamic cryptogram are then encapsulated within a transport layer security encryption tunnel for transit. Before the data has even entered the internet, your account details have been converted into a fortified, mathematically protected payload. The encrypted packet leaves the merchant's bank, the acquirer, and enters the global financial network. Banks do not communicate with each other directly. Instead, every transaction packet must be routed through dedicated middlemen who act as global couriers. This diagram tracks our data packet as it enters a centralized card network hub, such as those operated by Visa or MasterCard. These networks serve as routing nodes. The hub reads the metadata, sorts the packet, and directs the authorization request down a specific path toward your issuing bank. While card networks handle high-frequency consumer retail, international institutional transfers move through a separate architecture. This represents the SWIFT network, the primary system for connecting financial institutions globally. Unlike a commercial bank, SWIFT holds no actual funds. The pulses moving across these lines are standardized text-based payment orders. SWIFT functions as a messaging protocol, coordinating ledger update instructions between over 11,000 financial institutions. Whether the network is consumer-facing or institutional, the middlemen perform the same function: the secure, authenticated routing of instructions to update a digital ledger. The routed data packet eventually reaches its destination, the issuing bank's server. In a fraction of a second, the bank must process the payload through 3 distinct logic gates. Gate 1 is authentication. The system verifies the card verification value and address, ensuring the person initiating the transaction is the actual account holder. Gate 2 involves fraud detection algorithms. This diagram illustrates how the system runs the transaction through a multivariable matrix, comparing the current request against established spending habits. It flags anomalies, like a geographic inconsistency, where a card is used in 2 distant cities simultaneously. If a severe risk is detected, it outputs a block command, declining the request. If the transaction clears the first 2 gates, it reaches Gate 3, authorization. This final check confirms the account has sufficient funds or credit to cover the cost. The bank then sends an authorization code back through the network to the merchant terminal, confirming that the funds have been reserved. An approved message on the terminal indicates that your data payload successfully navigated this gauntlet of cryptographic and algorithmic defenses. The initial 1.5-second window is now complete. The merchant is satisfied, and you have your purchase. However, this authorization is only a pending hold. The actual movement of money from your bank to the merchant's bank happens much later. At the end of the business day, the banks begin a process called clearing. Banks batch thousands of daily transactions together to calculate exactly how much they owe to every other institution in the network. Using a netting process, banks collapse debts into a single net difference. This is settled via reserve balances at a central bank. Using a double entry system, the ledger subtracts the amount from the payer and adds it to the payee. Money formally moves. No physical assets change hands. The definitive synchronization of these two database entries is the final reality of the transaction. Modern money moves through a sequence of secure messages. By instructing central databases to adjust their balances, this system uses cryptographic verification to maintain the accuracy of the global ledger.